Today, we will talk about high-low, HML, an essential concept in the world of finance. High-low, or the value premium, is an important concept in the Fama-French three-factor model. This model uses three factors to evaluate stock returns, and HML is one of them. It accounts for the spread in returns between value stocks and growth stocks. Specifically, it argues that companies with high book-to-market ratios, or value stocks, tend to outperform those with lower book-to-market values, known as growth stocks. The Fama-French three-factor model, developed by Eugene Fama and Kenneth French, uses three factors, including HML, to explain the excess returns in a manager's portfolio. The model shows that returns from portfolio managers are partly due to factors beyond their control. HML determines if a manager is relying on the value premium by investing in stocks with high book-to-market ratios to earn an abnormal return. In 2014, Fama and French updated their model to include 5 factors. In addition to the original 3, the new model adds the concept that companies reporting higher future earnings have higher returns in the stock market, and the investment factor, which suggests that aggressively investing in growth projects could lead to underperformance in the future. The Fama-French three-factor model aims to overcome the limitations of the capital asset pricing model. Empirical results from a 2012 study showed that the Fama-French three-factor model is better than CAPM at explaining expected returns. It tests the expected returns of a portfolio selection from the New York Stock Exchange according to both models and reveals that the new model had better results. High-low is a value premium that represents the spread in returns between companies with high book-to-market value ratios and companies with low book-to-market value ratios. The HML beta coefficient, found by linear regression, can take positive or negative values. A positive beta means that a portfolio has a positive relationship with the value premium, while a negative beta indicates that the portfolio behaves more like a growth stock portfolio. Here are 2 key takeaways. 1. High-low, HML, also referred to as the value premium, is used to evaluate stock returns in the Fama-French three-factor model. 2. The model shows that returns from portfolio managers are due to factors beyond their control, and HML helps determine if a manager is relying on the value premium. Hope this would help. Thanks for watching.